Welcome back to Investing Talk Podcast. Today we're looking into a question we've heard a lot lately. Is Rocket Pharmaceuticals a good buy right now? We've dug into some recent analyses, reports from A Invest, a detailed look at speculative biotech investing, really trying to get you the full picture. Our aim today is, well, to sort through the noise, pull out what really matters, and help you understand the critical points about Rocket Pharmaceuticals today. Now, Rocket Pharmaceuticals, it's kind of been seen as this high-risk, high-reward play for a bit, and with some pretty big moves recently, analysts weighing in, there's definitely a lot to unpack here. And hey, if you find this discussion useful while you're navigating these, let's face it, complex markets, please do remember to subscribe, maybe leave a comment. It genuinely helps us create more content like this for you. And if you can, maybe consider buying us a coffee. Your support really does keep the lights on. Also, if there's a particular company you're curious about, one you'd like us to examine next, just drop it in the comments below. Okay, so with that said, the big question. How exactly is Rocket Pharmaceuticals tackling its challenges? What's their plan, their strategy to, turn things around?
Yeah, it's interesting. What's really capturing attention is their 2025 strategic reorganization. Pretty aggressive move. They've actually gone ahead and cut their workforce by 30%. That's significant.
30%? Wow.
And alongside that, major cuts to operational costs. The clear target. They want to slash their cash burn by about 25%, projected.
Okay, so not just tinkering around the edges.
No, definitely not. It signals a really strong, deliberate pivot towards, efficiency. Financial discipline, which for a biotech at this stage is critical. And strategically, their focus now is like a laser beam on their AAV cardiovascular platform.
AAV, that's the gene therapy delivery method, right?
Yeah.
Adeno-associated virus.
Exactly. It's a common way to get gene therapies into target cells, here specifically for heart conditions. And within that platform, they're really prioritizing three key programs. You've got RPA-501 for Danon disease.
That's the rare genetic heart muscle disorder.
That's the one, often fatal. Then there's RPA-601 for PKP2-ACM, another serious inherited cardiomyopathy. And finally, RPA-701 for BAG3-DCM, which is a type of dilated cardiomyopathy.
Okay.
So these are all, calculated bets. They're targeting areas with high unmet need where there aren't many or any good treatments available. Smart move if you want to make a real impact.
That definitely sounds like a decisive shift. Cutting costs, narrowing the scientific focus, but, even the best strategy needs fuel in the tank. So let's talk money. You mentioned they reported, $271.5 million in cash back in June 2025?
That's right.
But also a nearly $69 million net loss just in Q2. How does that balance out? What's their actual financial runway look like with that kind of burn rate?
Yeah, that's the million-dollar question, isn't it? Or maybe the $271 million question. Look, Rocket claims they have enough liquidity to keep operations funded until the second quarter of 2027.
Okay, on the surface, that sounds pretty decent.
Well, and this is a big but, if you actually look at their annual cash burn rate, right now it's running at $206 million a year. So do the math. That translates to a runway of only about maybe 16 months based on current spending.
Okay. So a pretty significant gap between their projection and the reality of the current burn.
Exactly. That's the key insight for you as an investor. Don't just take the company's word for it. The burn rate suggests a much shorter fuse. It's a red flag. Now, to be fair, having no debt is a definite plus, and their current ratio, around 9.19, gives them some buffer.
Right.
But that fast cash consumption, it really implies they might need to raise more capital, unless they can drastically cut that burn further or, get something generating revenue well before that Q2 2027 date they're citing.
So yeah, the financial picture is tight. Let's call it tight. But we know in biotech, a couple of key breakthroughs can just completely rewrite the story. Let's shift gears then. Talk about those potential game changers. For anyone invested in biotech, FDA milestones, well, they're everything. What are those really crucial moments, those near-term catalysts that could potentially flip the script for Rocket?
You hit the nail on the head. The immediate future for Rocket really hinges on three critical regulatory developments. Each one is a potential major turning point. Okay, first up, resolving the clinical hold on RPA-501. This is huge. It's their program for Danon disease, potentially a $500 million plus opportunity.
And the hold is because?
The FDA put it on hold because of a fatal adverse event, sadly. It was linked to something called capillary leak syndrome.
I see. That's serious.
Very serious. It's where fluid leaks out of small blood vessels. It can cause organ damage, shock. So resolving this hold is paramount to even start the pivotal trials. They're working with the FDA and safety committees on it. Getting a clear path forward here would be massive. Second catalyst, the Kresladi BLA resubmission and the PRV potential.
BLA biologics license application. That's the big approval package for the FDA, right?
Exactly. For a biologic drug like Kresladi, if they can successfully resubmit that by the end of 2025, they could potentially get a priority review voucher, a PRV, sometime in 2026.
And that PRV, remind us why that's valuable.
Right, so this voucher is worth potentially over $100 million. And here's the kicker. They can sell it.
Sell it.
Yep, to another company. That company can then use it to get their own drug reviewed faster by the FDA. So for Rocket, it's potentially a quick injection of non-dilutive cash. Plus, just getting the BLA accepted validates their manufacturing process, which is a huge confidence booster. And the third one, the RMAT designation for RPA 601. RMAT stands for Regenerative Medicine Advanced Therapy.
Okay. What does that designation do?
It basically puts the therapy on a faster track with the FDA, accelerates the timelines, sometimes by years. This program targets a market estimated at over $150 million. And we've already seen the market react positively. The stock jumped, what, 15% when that RMAT designation was announced? Shows how much investors value these accelerated pathways.
Got it.
So yeah, connecting the dots, getting these regulatory green lights isn't just about moving the science forward. It's absolutely crucial for bringing in potential revenue, shoring up the finances, and really boosting investor confidence. These are the make or break moments.
Those catalysts definitely sound promising, real potential upside there. But let me play devil's advocate again. How much of that good news might already be baked into the stock price? Especially given that market skepticism you touched on earlier. And, what's the flip side of this? What are the big execution risks we need to keep front and center?
That's a really sharp question. What's already priced in? Often the market anticipates, sure, but for speculative biotech like this, it usually wants proof, concrete results. And yeah, despite the potential, Rocket's path is absolutely littered with significant risks, execution risks. First off, just clinical uncertainty. That's probably the biggest one.
You mean the RPA 501 hold and the Kresladi issues?
Exactly. The hold on RPA 501 plus that unresolved complete response letter for Kresladi, they just highlight how fragile the pipeline is. I mean, one major clinical setback or even just a long delay in sorting these out, it could just derail everything. Years of work, investor sentiment, poof, this sector can be brutally binary. Then there's that critical point about cash burn and dependency.
Relying on just a few key programs?
Right. They're heavily reliant on a pretty narrow set of programs right now. So any delay in getting approvals, or even a delay in selling that PRV if they get it, it could force them back to the market to raise more cash. And that might have to be at a discount, which means more dilution for existing shareholders.
That pre-revenue status really keeps them on a tightrope, doesn't it?
It's like a constant tightrope walk, yeah. Balancing the science against the financial reality.
Yeah.
And we can't just brush off the market volatility and skepticism.
The stock price tells a story there, down over 70% year to date.
Yeah, a huge drop, 73.5% as of mid-August 2025. And while things like that RMAT designation gave it a short-term pop, the sort of broader market indifference, it suggests there's still deep skepticism about whether they can create long-term value. The market seems to be saying, show me the money, or at least show me the consistent wins. And underpinning all of this is the basic funding risk.
Just needing the cash to keep going.
Pretty much. Being pre-revenue with a high burn rate means continuous funding is just essential. Essential for operations, for the clinical trials. Any hiccup there, maybe the capital markets get tight, maybe they struggle to secure funds, it could seriously hamstring everything they're trying to do. It's a foundational risk.
That's a sobering list of risks. Clinical uncertainty, the cash situation, market sentiment. If you had to pick the one thing, the single biggest potential roadblock that keeps analysts worried about Rocket, what would it be?
Without a doubt, it's got to be that RPA 501 clinical hold.
More than the cash burn.
Well, they're linked, but the hold itself, resolving it isn't just about one drug program. It's really about validating their entire AAV gene therapy platform for heart diseases. If they can't get that hold lifted, it casts a really long shadow over their whole pipeline, their whole approach. It would crush investor confidence, probably far more than any other single issue. That, combined with the burn rate, creates just immense pressure.
Okay, so we've covered the strategic shift, the tricky financials, those hopeful catalysts, and these very significant risks, especially that RPA 501 hold. Now, the stock's trading around, what, $3.09 as of mid-August, which is actually just above Jefferies' recently raised price target of $3. But Jefferies still has a hold rating on it. what should you as a potential investor read into that hold?
Yeah, that hold rating from Jefferies is pretty telling, isn't it? Yep. It suggests that, yeah, analysts see some positive developments. They've probably factored in things like the RMAT designation to some extent. They're cautiously optimistic, maybe.
But cautious is the key word.
Absolutely. They remain very wary of those big execution risks we just walked through.
Mhm.
So the hold acknowledges the potential, sure, but it's also a clear nod to the big hurdles still ahead. It's basically saying, we're not convinced enough to say buy, but it's not a sell either. It's a classic wait and see, suggesting they need more concrete proof of success before they're willing to upgrade their view.
Hmm.
If you wanted to see a truly bullish re-rating, something that would really change the story, you'd need clear green lights from the FDA.
Meaning,
Specifically, getting that RPA 501 hold lifted, that's number one, and getting the Kresladi BLA accepted for review. Those are paramount. Then actually selling that PRV for a good price, injecting $100 million plus onto the balance sheet, that would help a lot. Plus positive early data from RPA 7011, continued progress with RPA 601. Those would all be critical pieces to really shift sentiment and lock higher valuations. But the flip side is just as real. Any significant setback, a prolonged hold, another rejection letter from the FDA for Kresladi, disappointing trial data. Any of those could easily trigger a major sell-off. Push the stock way below where it is now. It really feels like it could swing dramatically either way based on these upcoming events. Very binary.
okay, so bringing it all together, we've laid out the potential, the very stark risks, the analyst caution. The big question remains, is now a good time to buy Rocket Pharmaceuticals? What's the overall investment thesis here for our listeners?
Well, based on our sources, the consensus is pretty clear. Rocket Pharmaceuticals is still a highly speculative investment. It's really only suitable for investors who have a high tolerance for risk.
Because the fundamentals aren't great.
Yes, exactly. Well, there's definitely significant upside potential if the clinical programs hit their marks. The current fundamentals, they're poor. You've got ongoing losses, that high cash burn we discussed, basically no revenue to speak of, and this heavy reliance on investor sentiment and, well, hoping for positive trial news. And while analyst price targets look high on paper, you have to remember this company has a history of those targets not quite panning out. The technical trend for the stock, still weak. Negative sentiment is dominant. So for anyone even thinking about it, that cautious optimism needs to be paired with a really solid risk management plan.
Like what? What did the sources suggest?
Okay, so for an entry point, some suggest maybe waiting for a dip below $2.80. Try to align with some previous targets, but definitely factor in the volatility. It could swing wildly. For a stop loss, setting a hard stop around $2 is probably wise. That's to limit your downside if those regulatory hurdles don't get cleared.
And how long should you plan to hold?
Given the key catalyst, a holding period of maybe 6 to 12 months makes sense. That time frame should give you enough visibility on the FDA's decisions regarding RPA 501 and Kresladi. Those decisions are really going to dictate the near-term direction. Bottom line, it's best suited for, speculative, maybe longer-term biotech investors. People who understand the risks, are prepared for the possibility of losing capital, but are looking for those potential multi-bagger returns if things go right with trials or approvals. Trying to trade this short-term. Extremely high risk. Very volatile. So in essence, yeah, Rocket's journey through 2025 and into 2026, it's a high-stakes gamble. No way around it. That strategic shift to cardiovascular gene therapies, those crucial FDA milestones, they offer this compelling story, right? Resilience, reinvention. But those execution risks we talked about, they are very real, very elevated. Success totally depends on whether they can translate that scientific promise into actual commercial reality. So keeping a close eye on FDA news and closely monitoring their cash flow, that's going to be absolutely critical for anyone following this company.
Absolutely. And an excellent summary. It really drives home that paradox, doesn't it? You see these analyst targets suggesting potentially huge upside.
Yeah, 230%, even 600% upside suggested by some targets.
Right. But then you contrast that with the market's clear skepticism shown by that big stock price drop this year and the company's own history of, well, not quite hitting predictions. So for you, the listener, the challenge becomes, how do you weigh that expert optimism, however cautious, against the cold, hard reality of past performance and the current market mood when you look at Rocket Pharmaceuticals? Definitely something interesting to mull over. Thank you for joining us for this look into Rocket Pharmaceuticals. We really hope this has given you a clearer perspective.